All right, let's talk about the 3 stocks I like for December of 2018. Now remember, I am a value style investor. These stocks aren't going to instantly jump up by 50%. It's a long-term investment that I feel the stocks are fairly valued at this point. They're solid companies, and over the long term, you should have a decent return with these stocks. The first stock is Home Depot, symbol HD. Now, they were doing great over the last few months. They ran up significantly, and I've talked about them in other videos. I'll actually link to the Home Depot analysis video I did up above, but right now they're kind of struggling. A lot of stocks, there's a lot of volatility in the market, days of where things are shooting up, days where things are shooting down. Home Depot is actually getting hurt pretty good. A lot of the retail stocks are down. Obviously, Home Depot's a retailer, and there is a lot of uncertainty in the market. Housing prices, housing sales are going down. That's impacting Home Depot stock. So right now, I recommend buying Home Depot on the dips. Obviously, you got to talk with a financial advisor, but that is what I'm doing personally in my portfolio. As Home Depot goes down, I'm buying a little bit more. As they go down more, I'm buying a little bit more. So let's talk about why I like Home Depot. First off, the price to earnings ratio, the PE ratio, is below 20. This is something I generally, if I'm going to generalize the frameworks I use to invest in stocks, I like to see a PE below 20. Once it gets above 20 or significantly above 20, it just seems, in my opinion, in most cases, it's too expensive for the stock I'm looking at. The number one driving factor why I like Home Depot is Sears bankruptcy. And let me tell you why. Sears sold a decent amount of appliances, and there's really 2 main beneficiaries of Sears no longer selling appliances: Home Depot and Lowe's in most areas of the United States. So taking Sears out of the picture, I think Home Depot is going to significantly benefit from the lost appliance sales of Sears. So, and the reason why I think Home Depot will benefit more than Lowe's, Lowe's does not stock any appliances. So you go there and order a refrigerator, and this actually happened to my wife and I. We built a house, we had no appliances because we sold the other appliances with our old house, and we went to Lowe's and ordered a Samsung refrigerator. And we were told it would be in within a week or 2. We actually waited a month and a half, and Lowe's said, hey, we can't even get this. We don't know when we're going to get this. So we end up buying an LG refrigerator. Home Depot stocks a lot more refrigerators in a central warehouse, so you don't have to wait as long. So I really think people are going to migrate to Home Depot to buy a lot of appliances. Continuing talking about the Sears closures, out of the Sears and Kmart stores, which were recently announced as going to be closing, there are Home Depots within 5 miles from those 116 stores. So that means these Home Depots are near where Sears are closing, which logically a lot of the customers that would have went to Sears are now going to go to Home Depot. Initial estimates said that about $157 million this could add to Home Depot's sales, and that's just directly for appliances. That doesn't count other things, miscellaneous type purchases that these customers are also going to make at Home Depot when they go to buy the refrigerator or the washer and dryer, things like that. All right, the next stock is symbol USB, US Savings Bank. Many of the financial stocks haven't experienced a significant run-up that other stocks have experienced recently, and US Bank has a PE of around 12, so it's well below the 20 threshold that I like to see. And interest rates have been going up. Generally, when interest rates go up, the profits that banks make go up. US Bank is a well-run bank. They have a fairly big footprint in the United States. So initially, banks that are well run, as interest rates go up, they tend to do a little bit better. They don't take as much risk as some of the other larger banks, and banks that take more risk generally short-term perform better. Long-term, when the economy starts turning down, which now we're in that kind of transition phase, are we going to have a recession? Are we not? Along with the interest rates going up, this is when well-run banks that are risk adverse do the best, because they got interest rates going up, they got other banks that have taken on way too much risk doing bad, and that's generally when these well-run banks will think about doing an acquisition and purchasing those banks that are struggling, bring them into their portfolio, expand the amount of branches they have, bring in wealth clients, things like that from these over-leveraged banks. And U.S. Bank is a very well-run kind of super regional bank, and I really think over the next few years, U.S. Bank is going to be a good investment. All right, so the third stock I'm going to talk about that I like for December 2018 is Blackrock. Blackrock is it's a diversified organization that offers many investment type products, everything from simple index or ETF based funds to almost products that are similar to like hedge funds. So they're diversified across a wide range of investment products, and they attract a wide range of individuals who are right for those products. Everything from high-powered, high-income, high-asset-based clients to regular individuals that are looking simply for index-based solutions. I do have to say that BlackRock is a little bit more risky than Home Depot or US Bank that I talked about previously, so take that into account. I'm not recommending this stock for you. I'm just saying it's something I'm looking at. Year to date, they're down 24%. So, they are struggling year to date. They are driven down. A lot of the financial type stocks are in more of a value territory right now than compared to some of the other stocks. So that's why there's two different, banking / financial stocks that I'm looking at right now. So let's talk about why the stock is down this year. It's namely down because of general market pressures. There's nothing really with BlackRock that warrants the stock being driven down nearly 25% year to date. They do have a little bit slower organic growth than they have in the past, so that's one thing that may be helping that people are scared of, that's driving down the stock. They're worried that those headwinds are going to continue. The thing I really like about BlackRock is they're diversified across types of product offerings, geographies, and also scale. They've also started developing new wealth management partnerships, so long term this should help make up for some of the struggles that they're experiencing. Currently they have around a 3.2% dividend yield, so this is a pretty reasonable yield based against other financial and banking type stocks. So again, I invest a lot in dividends, so I like seeing a 3.2% yield here. And they have a relatively low dividend payout ratio. It's somewhere around the 40% range, which is, I like seeing anything under 60%. It gives some room for them to continue to increase dividends over the years. Another thing I like about BlackRock is they have almost 11% average 5-year growth rate, where other stocks within the financial industry are only around a 5 to 6% growth rate. So again, the faster than industry average growth is a good sign. It should help them continue to outperform other companies within that industry. All right, guys, I hope you like these stock recommendations. And again, these aren't recommendations for you. These are stocks that I'm recommending you do further research and talk with your investment advisors on to see if they fit your portfolio. And they are stocks that I am researching for my own portfolio that I might consider investing in. So if you have any questions, don't forget to post in the comments below. And I hope you like this video, and don't forget to subscribe.